Introducing Ausbiz Capital GrowWise, a new fund which combines institutional insight and experience with a target return of 15% per annum.
Our fund mirrors SciTech GrowWise, backed by an 18-year track record with historical 21% average annual net return. With more than $1.45 billion under management, the SciTech GrowWise Fund is led by award-winning global portfolio manager Ivan Sherman. The same strategy is now available to Australian investors from as little as $5,000. Discover Ausbiz Capital GrowWise, investing informed by experience.
Hello and welcome to the Global View on this Wednesday. I'm Andrew Gagan. Good to have you with us again here at Ausbiz as we get across what we've seen globally overnight. Shares rising as US inflation met expectations, European shares gaining on optimism also about the US-China tariff truce. Now on Wall Street, the US consumer price data buoyed sentiment on the improved prospect of an interest rate cut in September. The S&P 500 and Nasdaq ending at record closing highs. Checking in on the Mag 7, Alphabet being a strong performer there as Perplexity made a $35.5 billion cash offer to buy the company's Chrome browser. Intel climbed after President Trump met its chief executive Lou Boutin in praising him, despite having demanded his immediate resignation last week over his ties to Chinese firms. And an index tracking airline stock surge, putting it on track for its biggest one-day rise in more than a month after the inflation data showed airfares rose 4% in July. Bank stocks rallied as analysts said a steepening of the yield curve could help banks' earnings as lenders could borrow cheap and lend at a higher rate. Well, the US Consumer Price Index rose 2.7% in the 12 months through to July, which was slightly below forecasts. Excluding volatile food and energy components, core CPI was up 0.3% for the month, the biggest gain since January, lifted by higher prices for services, including 4% increase in airfares. Economists have suggested the disinflationary trend in services is stalling, with a record surge in the cost of healthcare prices also. And the US government's budget deficit grew nearly 20% in July to $291 billion, despite a $21 billion jump in customs duty collections from tariffs, with outlays growing faster than receipts. The US government's gross national debt surpassing $37 trillion. Fed funds futures traders are pricing in 94% odds that the Fed will cut its rates at the mid-September meeting. That's according to CME Group's FedWatch tool. Interest rate sensitive two-year Treasury yields fell in response to the inflation data to be at 3.73%, while the 10-year yield was slightly higher at 4.29%, and the US dollar fell across the board after that data, while the British pound was up 0.5% on the dollar as UK jobs market weakened further, the Aussie at 65.3 US cents. And Bitcoin is trading at around 120,000 US dollars. Oil prices have dipped as traders anticipate declining demand at the end of the US summer driving season in early September. Brent crude futures at $66 a barrel. Copper up more than 1.5%. Iron ore rose 1% to 103 US dollars a tonne, and gold edged higher after US inflation data, raising expectations of further interest rate cuts. Spot gold at around $3,345 an ounce. Now, to get across what we saw on US markets overnight, particularly in the wake of that inflation read, I caught up with Marcus Padley from Marcus Today.
The chances of a rate cut were already sitting at 85%. I think they're up to 95%. But the message from that CPI number, this CPI number, everything at the moment, but this CPI number was a risk. And the risk was that we saw an acceleration of what we saw in the last CPI number, which was this new catchphrase tariff pass through. And there hasn't been much, if any, evidence of that accelerating. So everybody's relaxed. Suddenly the markets are off again. And on the tariff front, I was particularly taken. I don't think anyone made too much of a fuss of it, but Scott Besant said yesterday that if trade deficits come down, then tariffs can be removed. And if that's the case, then this whole episode has been, as usual, a negotiation rather than a long-term imposition of tariffs that will destroy the US economy. So I think this CPI number gives us a bit of a green light until the next CPI number, which is on September the 11th. Then we've got the Fed meeting on September the 17th. The other hurdles, or the other major hurdle, I think, for the US market, which is big tech sentiment related, is the Nvidia results on the 28th. But I can't see any reason why Nvidia should not impress. The only problem with big tech at the moment is price, not fundamentals. You know, this is not a tech boom. These companies have got cash. They are growing. Here we are with the biggest company in the world growing earnings at 40% this year. So I don't see any reason. They can't sell enough chips. They can't make enough chips. So I don't see any reason why the results should be bad. So with this CPI number relaxing us, I think it's green light on the market until the next thing goes wrong, and we don't really have much happening till Nvidia and then a CPI number in a month. So let's get on with it.
All right, so what you'd be happy to be fully invested then, given, well, obviously like that, we've seen the Nasdaq, the S&P reaching new record highs again. So obviously, you know, those valuations, are they, I mean, just how stretched are they?
They're pretty stretched, it's got to be said. At the bottom of the market this year, when we were in the post-Liberation Day disaster scenario, the PE on the Big Six, or the Mag Six, got down below 30 times again, and that clearly everybody bought it, with falling over themselves to buy it at that valuation. And we're back up over 35 times at the moment, and there's absolutely no doubt there's a lot of sentiment in the price rather than solid fundamental support. But we've been running like that for a while, and we can continue to run like that. The silly thing is, Andrew, when you go back and look at things like market crashes, ahead of the 87 crash, I think the All Ords went up something over 100% in the 18 months prior. Some of the best bits of the market are where people lose their heads in both directions. And I don't think a little bit of overvaluation, as long as there's no disturbance in the force, is a reason to sell the market and step back. The game is to react, not predict. We'll wait for something to go wrong and react to it. But for now, sentiment is good, and that CPI number helps.
Meanwhile, on the local market, at record highs as well, also buoyed by that rate cut yesterday.
Yeah, and again, nobody really picked up on it. But if you watch the Michelle Bullock press conference, she's bringing a new formula to central bank utterances, which is to be entirely straightforward, and it's not so much tell the truth, it's don't spin a line. And central banks have been trying to spin confidence for decades at every turn. And here she is saying, clearly had veiled warnings about things can happen in the US. It's unknown. There are unknowns, and we'll react to them when they happen. But as far as what happens, you heard her talking about growth and productivity. She doesn't know, and she doesn't know. And one of the lessons she's taught us over the last couple of meetings is that the RBA make their decisions pretty much on the day, and it's not formulated, and it is wait and see. So she's doing. I think she must be a subscriber to Marcus Today, because that's what we do. We don't predict. We wait for things to happen, make decisions every day, and remain hyper vigilant. And that's what she's telling us the RBA's doing. They are the mouse on the elephant's back of the US, it's got to be said. But she was telling us quite refreshingly, I thought, that we don't really know what's going to happen, but we're hyper vigilant, and when it happens, we'll do something about it if we can.
All right. Well, interesting. Maybe she is a subscriber. You never know, Marcus. Listen, let's just take a look at lithium stocks. I know you're taking a look at that. Clearly, given the movement we've seen there in the past couple of days, rocketing a couple of days ago. Now, this was off the back of a mine closure in China. Looks as though China's potentially trying to manipulate that that commodity price there. Then they came back yesterday. I mean, is there a time to get in now, do you think?
Look, I still... Well, we're trying to make money out of themes and get themes right. And there are various commodity themes that we can exploit through exchange traded funds. And for lithium, it would be, Global X's AC/DC, for instance. Would we buy that? I'm afraid not. Our big bet at the moment is the US market and big tech. And I don't think we're getting paid by investors to keep them awake at night. And one of our new principles is let's not be cowboys. People just want to participate in a bull market, avoid precipitous moments. We don't need to be overly clever. Now, in order to get lithium right, you've got to be clever. And this could be, I've read some of the research, I've tried to work out whether this is a major pivot point. It could be, but we don't need to get that right. And if we did it, it would only be in small size. It's unreliable. Most of the research suggests that this is a moment production hiccup that has driven the price. Plus, the sector is shorted to extremes, and understandably so, with the price constantly going down. If this might last for a while, maybe they can manipulate the price higher. It does look like a significant pivot point on the charts, and good luck to those who try. But the fundamentals are not there. It's not reliable. It's a trade, and as far as we're concerned with our strategy portfolio, we don't need it, but I can see traders buying it, and if you're going to buy it, keep a really good eye on it.
Fair enough. Marcus, we're pretty much out of time. Just briefly, need to ask you about the big one. You've referenced that yesterday. What do you mean?
Right, go and ask ChatGPT for a synopsis of the book I've been reading, which is Ray Dalio's How Countries Go Broke. And he talks about an 80-year debt cycle, which started in the US in 1945, and US debt to holdings of gold in 1945. The ratio was about 7 times. It's now 37 times. He again's making a veiled warning that at some point the US could lose control of their debt. But the good news is, having read the book, if you read the book, you'll sell everything and buy gold and crypto, right? But don't read the book, and there'll be plenty of signs on the way to that event, which you'll wake up to, and you'll get pushed to realize something's happening. He's just warning us that the big one day could happen, and we're sort of at that 80-year time frame now, and the US is in the hands of people who don't seem to care too much about how much they borrow.
Well, that sounds a little ominous. That is Marcus Padley from Marcus Today. We are about to get going here on the local market, expecting another record high, given the SPI futures are up almost 1/5%. Well, let's stay with us because the open is here.